Hello and welcome to Session 16 of the Basic Tax course. We're going to begin Session 16 with a review of the Session 14 quiz answer key. I have up in front of you now the Session 14 quiz, and the first question I'm going to review as the most frequently missed question is question number 5. Assuming you are not claiming bonus depreciation, the maximum depreciation deduction you can claim on a passenger automobile for 2010 is $3,060. However, if you claimed a Section 179 deduction, the maximum depreciation will be more. That's a definite false. The passenger limit for first-year depreciation on an automobile is $3,060, period. And it doesn't matter whether you claim maker's depreciation or whether you claim a Section 179 deduction, that same level applies, or that same limit applies. Now, if you claim bonus depreciation during the year, the limit is increased by $8,000. But we specifically told you that no bonus depreciation was being claimed, and so there's no increase to the limit. $3,060 is it. And of course, if the vehicle is less than 100% business use, that $3,060 limit must be further reduced by multiplying it by the percentage business use. The next question I'm going to review is question number 11. Real property includes which of the following? A, your home, B, your car, C, a photocopier you use in your business, D, your home computer, or E, all of the above. Well, real property is real estate, and I only see one piece of real estate listed there, and that makes answer A the correct answer. Question number 14. Maker's 200% declining balance applies to 3, 5, and 7-year property not held for farming only. That is a false answer because 200% declining balance also applies to 10-year property, which was omitted in the list. Number 16, you can claim a Section 179 deduction for the cost of a dishwasher you install in your residential rental property. That is false. You are not allowed to claim a Section 179 deduction on property you lease to others. A rental home is being rented, and anything in the home is being rented with the home. Therefore, you cannot claim a Section 179 deduction for improvements that you make or appliances or furnishings that you purchase for a rental property. Number 17, you can claim a Section 179 deduction for the business use portion of the value of your car, subject to the limits on passenger automobiles, if the business use percentage on your car is 50% or more. That is a false statement. The reason for that is that in order to claim a Section 179 deduction on listed property, it must be used in your business more than 50%. 50% or more is not enough because 50% is not enough. Number 21. In 2010, you sold a desk for which you previously elected to claim a Section 179 deduction. How do you figure your recapture amount? Well, just think back visually to what happens on Form 4797. And a recapture of depreciation on Section 1245 property is recovered on Form 1040, line 14. So you recapture depreciation on Section 1245 property on line 14 of Form 1040. Line 14 is taxed as ordinary income, and that makes C the correct answer. Figure the amount of gain realized upon disposition of the asset that is due to previously allowed or allowable depreciation, Section 179 deduction, or special depreciation allowance, and then report this amount as ordinary income. So you report the sale on Form 4797, and then recapture depreciation is reported on Form 1040, line 14, as ordinary income. And here is the mini problem that we gave you for depreciation calculations. Joe's Heating and Air Conditioning is a home-based business. Business profits prior to any deductions for depreciation totaled $50,000. Joe purchased and placed in service the following assets during the year. He had a laptop computer, which is 5-year property, 100% business use, and a cost of $1,200. He also placed in service a generator, which is 7-year property, costing $800 and 100% business use. And finally, a Dodge Caravan, weighing under 6,000 pounds, so it makes it listed property subject to the limits on automobiles. And the purchase date or date placed in service on that vehicle was 7/1 of 10. 85% business use with a cost of $25,000. Now, the maximum auto depreciation in 2010 is $3,060. We do not want you to claim the special depreciation allowance on any asset. Joe would like to depreciate the generator and the van. He would like to expense the computer. Using the maker's tables provided, complete the attached Form 4562 and then answer the questions 22 through 27, rounding your answers to the nearest dollar. So we've given you 5-year maker's table, 7-year maker's table, but let's just talk about these assets and the instructions up here. The laptop, the instructions are to Section 179, the laptop. And since the laptop is listed property, we're going to need to report that in Part 5 of Form 4562. The generator is being depreciated, double declining balance, and it will be reported on line 19 in Part 3 of Form 4562. And the caravan is also listed property, so it will get reported in Part 5 of Form 4562. So let's pull up the 4562 and see what we have. Now remember, when we start with Form 4562, we should start on page 2 when we're dealing with listed property, or when there is a need to complete page 2, we should complete page 2 before we move over to page 1, and the reason for that is that line amounts we figure on page 2 carry over to page 1. So the two assets that need to be reported on page 2 are the computer and the Dodge Caravan, because they are both listed property. We enter the date placed in service, the percentage business use, and the cost or other basis. In the case of the caravan, of course, it is 85% business use. The cost is $25,000, but we multiply that by 85% business use to get a depreciable basis of $21,250. The van is being depreciated under double declining balance, but it is subject to the limits on automobiles, and so we're going to take $3,610, multiply that by 85%, and when we do that, we get $2,601. The computer is being Section 179. So we enter $1,200 as a Section 179 deduction on column G of line 26. Then $1,200 carries to line 29, and line 29 carries to line 7 on page 1, where we enter information regarding Section 179 deduction. And line 28 carries to line 21 on page 1. So let's go take a look at page 1 now. Beginning up at the top of the form, the maximum amount of Section 179 deduction allowed for most businesses in 2010 is $500,000, and that is the amount that is entered on line 1. Then on line 2, we enter the amount or cost of Section 179 property placed in service by the taxpayer during the year. And where did that number come from? Well, the total amount to enter on line 2 of Form 4562 is the cost or value of the assets placed in service during the year. We have the van, 85% business use with a cost basis for the business of $21,250, the laptop computer at $1,200, the generator at $800. So the total amount that we will carry to Part 1 and enter on line 2 is $23,250. And that is the amount we entered right here. Next, we enter the top limit or cost on property that can be placed in service during the year before a phase-out begins, and that is $2 million. There's no reduction in the amount of Section 179 deduction this taxpayer is eligible for, because the cost of property placed in service during the year is far less than $500,000, and it is also far less than $2 million. The amount that we are claiming a Section 179 deduction for is the laptop computer, and we are carrying that entry from line 29 in Part 5, and we then enter that on line 7. There are no further limits. We carry $1,200 to line 12, and then we make our entries on line 19. There is only one entry on line 19, and that is for the generator, costing $800. It is 7-year property with a half-year convention and 200% declining balance. You simply divide 800 by 7 and you will get $114, which you then enter in column G. We add the amount in column G, the amount on line 12, and the amount from Part 5 of Form 4562 from line 28 in Part 5, and we enter that on line 21. So we take $1,200 plus $114 plus $2,601, and we get $3,915. So that concludes the review of the quiz answer key. If you have any other questions about the Session 14 quiz, which covered depreciation, please enter your questions into the Q&A forum for Session 16, and I'll be happy to clarify anything you are still confused about. The next topic of the day is to review the Session 15 homework assignment. And of course, the Session 15 homework assignment was a pretty detailed assignment. I promised it would be difficult, and I'm sure you did struggle with it. The forms that I asked you to complete as a part of this assignment were Form 1040, Schedule A, Schedule D, Schedule E, Form 4797, the Schedule D tax worksheet, the Section 1250 gain recapture worksheet or unrecaptured gain worksheet for line 19. And here is the problem. Diana Prince lives on Paradise Way in Washington, D.C., and she sold her rental home at 191 Action Street to Steve Trevor for $180,000 on April 3 of 2010. The rental house was vacant until the date of the sale, and Diana paid the following expenses maintaining the property until it sold. Property taxes of $500, mortgage interest of $4,000, and utilities of $500. Diana originally purchased the rental house on January 15, 2001 for $98,000. The land was worth $17,000 at the time of purchase. She did not live in the home at any time, and she had the following closing costs on purchase of the property, which were added to the depreciable cost basis. Title charges of $700, other closing costs of $500, and taxes paid for the seller in the amount of $800. Over the years, Diana had made the following improvements to the property: a new roof of $5,000, a remodel on the kitchen of $5,000, repairs of $1,600, new refrigerator of $500, new carpet of $1,600, and a new fence of $2,000. Diana has assigned a portion of the net proceeds from the $180,000 sales price to each of the assets as follows. She believes that the selling price of the house itself as a separate amount from the land value is $140,200, and the land is $30,000 in value. She believes the refrigerator is $200, the roof is $3,600, the remodeled kitchen is valued at $3,600, the carpet at $1,200, and the fence at $1,200. Diana incurred the following expenses in relation to the sale of the property. Fixing up expenses that she paid within 6 months of the sale were $1,400. Real estate commissions paid were $10,900, and closing costs were $1,800. For purposes of completing Form 4797, allocate these selling expenses to the cost basis of the home. And here we have a depreciation schedule for the home. It shows the rental house was initially placed in service on 1/15 of 2001 at a cost of $83,000. And of course, that is a separate amount from the land value that was pulled out. So even though the total cost of the property was $100,000, we've pulled out $17,000 as a land value, which cannot be depreciated. And we do show that the total accumulated depreciation on the rental home is $27,037, and that 2010 depreciation is $880. We further go on to define or show the placed in service dates of all of the other property used in the rental, the accumulated depreciation, and the 2010 depreciation. Now, of course, this net total depreciation amount for 2010 needs to carry over to the Schedule D. Diana also has a job with the U.S. Air Force, and she received $90,000 of pay for the year, $25,000 of federal withholding, and $7,500 of D.C. withholding. Diana did not rent out the rental property during the year. It was left vacant to make it easier to sell. Prepare Diana's federal tax return. Well, let's take a look at the answer key for Diana Prince. Diana Prince has sold a business use asset. She must continue to claim depreciation on the rental home through the date of sale. Schedule E is attached to the return to report the depreciation expense. The reason for this is that when you have a property that is a rental property, if you stop renting it so that you can sell it, it doesn't mean that it's no longer a rental property. It is still a rental property. So you would need to file Schedule E to report all of the normal expenses of that rental property for the year up until the point that it sells. And so we have a Schedule E that is included in the answer key for this problem. There's an important point that I want to discuss with you because this is a question that I've been asked many times over the years by our students. And essentially, students want to know why we divided up the sale of all of the individual parts of the property into individual components? And is it correct to do it that way? And what happens if you don't do it that way and treat everything as a lump amount? Well, here's my answer. Should the sale of the house and its individual improvements be treated as a single sale on Form 4797, or should the sales price be broken down and allocated to the house and each improvement separately? Well, I was curious. My students kept asking me why I was doing it that way, and the answer was, well, that's the only way I could make the computer software give me the right answer. But I decided I should call the IRS to find out what the IRS would have to say about this, and I talked to an auditor. And he expressed the following opinions. Any reasonable allocation method is acceptable. It is equally reasonable to lump all assets into a single sale, and that is the way it is usually done, or to break the sale down into its component parts. If you choose to break the sale into its component parts, you should allocate a sales price to each of the improvements that is equal to either the fair market value of each component or the adjusted basis of each component. It would not be correct, however, to give zero sales price valuation to the sale of a component part if giving such a valuation would generate a significant loss on Form 4797 where no loss has actually occurred. So really the reason why we have prepared the answer key for Diana prints the way we have is that tax software thinks and works in a particular way. And since Diana sold business use property where the current year depreciation is being claimed, we have to consider how a particular computer software will be able to accurately calculate current year depreciation and apply the half-year or mid-month convention to each asset as it is disposed of. Both Drake Software and another software company called ProSeries require you to treat the sale of the house and its improvements as the sale of individual components. That's the only way it can actually generate depreciation. Now you can, of course, do other entries manually to override a bunch of stuff, calculate things manually, and then enter your total numbers. You can do it that way. However, just understanding the way tax software works, it's simply easier to continue depreciation, enter a date sold on each item, and the software will then calculate the net gain or loss realized on the disposition of each asset that is showing up on the depreciation schedule. Now, without that type of individual treatment, the software is not able to accurately figure current year depreciation or whether any of the gain or loss is Section 1250 or Section 1245 gain. So in working to prepare Diana Prince's taxes using our software, we have chosen to sell the house and its improvements separately because it allows the software to accurately reflect current year depreciation. We have elected to use fair market value as a valuation method to allocate the proceeds from the sale of the property as shown in the problem. Looking at Form 4797 Part 1, long-term losses and the land will get reported in Part 1 of the form. It turns out that the new roof, the remodeled kitchen, the fence are assets that were held long-term and sold actually at a loss. The land was held long-term and sold at a gain. Enter sales information for these assets as described here, and I will show you how that looks in a minute. Part 2, short-term gains and losses are reported in Part 2 on line 10. The carpet was held short-term. Enter the sales information for the carpet on line 10. Schedule D. After you figure Diana Prince's net gain from the sale of the house on Form 4797, it is going to flow through to Schedule D, and the net losses from the sale of the new roof and the kitchen remodel are subtracted from the net gain of the house when you are carrying the total to Schedule D, line 11. So let's go take a look at all that. And here is Diana's Form 4797. We show the land. The land had an original cost basis of $17,000. It sells for $30,000 and produces a gain of $13,000. The new roof had an original cost of $5,000. Prior depreciation claimed was $713,000, and the sales price allocated to the new roof is $3,600. So we take $713,000, subtract that from $5,000, and then subtract that balance from $3,600. When we do that, we get a loss of $687. Next, we have the remodeled kitchen. The cost on that kitchen was $5,000. We've claimed $667 of depreciation. It sells for $3,600 and produces a loss of $733. The new fence had a cost of $2,000, prior depreciation of $538, a sales price of $1,200, producing a loss of $262. The new carpet was placed in service on June 30, 2009 and sold on 4/3 of 2010. That makes it short-term. Prior depreciation claimed on the carpet is $576, and the cost of the carpet was $1,600. We allocated $1,200 of the sales price to the carpet, giving a gain of $176, which of course is a recapture of depreciation. In page 2, or part 3 of Form 4797, we show the assets for which depreciation was claimed and which sold at a gain. And among those we have the rental house. We show the sales price allocated to the house at $140,200, the cost basis of the house at $97,100. Prior depreciation claimed is $27,917, giving an adjusted basis of $69,183. Total gain from the sale is $71,017. We then go over to the refrigerator. The refrigerator has a sales price of $200, an original cost of $500, and prior depreciation claimed of $443. So that means the adjusted basis in the refrigerator was only $57. So when it sold for $200, it actually sold at a gain of $143, and that $143 of gain is going to be taxed as ordinary income reportable on line 14 of Form 1040. Next, we move to the bottom of the form, and on line 30, we enter total gains of $71,060. That's $71,117 plus $143 gives us $71,160. And of that $71,160, $143 is taxable as ordinary income, and $71,017 is capital gain income. We're going to carry $71,017 to the front page of Form 4797, and we're also going to carry the $143 to the front page of Form 4797. $71,017 of gain realized on the sale of the rental house is entered on line 6. We then add up the amounts shown in column G and enter the total on line 7. That's $82,335. We then enter the $143 of recaptured depreciation on line 13 and add that to the $176. So in the end, we have on line 17 $319 of income that will carry to Form 1040 line 14, and we have $82,335 that will carry to line 13 of Form 1040. We also need to figure the rest of Diana Prince's tax return, so let's do that next. We begin on the line 1 by entering Diana's filing status as single. We then give her one exemption deduction on line 6A. Her wages on her W-2 were $90,000. Then on line 13, we enter that capital gain as shown on Form 4797, $82,335, and we enter the ordinary income reported on Form 4797 of $319. We also have a negative number or loss entered on line 17, and that's actually coming from the Schedule E. So let's go take a look at where we got that number from. And here is Diana's Schedule E. Now in the wording of the problem, we gave you a few simple expenses for the property that Diana paid during the year, including mortgage interest of $4,000, taxes of $500, utilities of $500, and the depreciation schedule showed $1,348 of depreciation for the year. So that gives her total expenses for the year of $6,348. She had no income. So we take $6,348, that is a total loss for the year. The loss is an allowable deduction for Diana, and we enter that on line 26 and carry that loss to Form 1040 and enter it on line 17. And here it is again. We total up Diana's income for the year, and we get $166,306. She has no adjustments. We carry that total to line 38. She's claiming itemized deductions, and let me show you the itemized deductions she had. They were really quite simple. The only itemized deduction she had was taxes that she paid to the District of Columbia in the amount of $7,500, but that is more than her standard deduction. So that is the amount we will enter on line 40. We then subtract out her exemption deduction of $3,650, and we arrive with a number on line 43. Taxable income is $155,156. And now, of course, it is time to do the capital gain worksheet. But let's take a look at Schedule D first. Here is Diana's Schedule D, and we can see that on line 11 we're carrying over the capital gain income shown on Form 4797. And that capital gain income carried to Form 1040 line 13 in the amount of $82,335. We enter that total again on line 15 and line 16. And then on line 19, we are asked to enter the amount of unrecaptured Section 1250 gain on that rental property. That amount was $27,917. The instructions tell you to take that number and enter it on line 18. So now we need to complete the capital gain worksheet. We begin the capital gain worksheet by entering the total amount of taxable income shown on line 43 of Diana's tax return. That was $155,156. The next step is to show the amount of capital gain income on line 16 of Schedule D, and that was $82,335. From the $82,335, we subtract out the amount of depreciation that is included in that figure, or unrecaptured Section 1250 gain, and that is $27,917. We enter the difference on line 13, and that gives us $54,413. We then subtract line 13 from line 1, and the total is $100,738. The next step is to see what amount applies to Diana's filing status as a base amount, and that is $34,000. The instructions say to enter the smaller of line 1 or line 15, and of course that is the $34,000. Next on line 18, we subtract line 10, that's this number, from line 1, and that gives us $72,821. This is the amount of ordinary income that Diana has for the year, and that carries over to line 19. We will then go look up the amount of income tax owed on $72,821 in the IRS tax tables shown in Pub 17. When we look up the amount of tax that Diana owes based on her filing status, we get $14,388, and we enter that on line 34. Next, it's time to break down the amount on line 19 into its component parts. And of this amount, $27,917 is subject to a maximum capital gain rate of 25%. Depending on Diana's income, her income could put her in a position where she wouldn't have to pay 25% maximum rate gain. But we can see that her income is much higher than the base amount. If her income were less than $34,000, the maximum amount of tax she would be paying on this unrecaptured gain would be limited to the tax bracket that she's in. But her income exceeds this amount. That means she's pushed herself into the 25% bracket or higher. And since she's in a bracket of 25% or higher, she is going to report $27,917 is going to be taxed at a maximum rate of 25%. We take $27,917, multiply that by 25%, and enter the total $69.79 on line 30. The final step is to take the remaining $54,418 of capital gain and tax that at a maximum rate of 15%. The total we get is $8,163. We then take $8,163, $69.79, and $14,388 and total those numbers. The total we get is $29,530. The next step is to look at the amount entered on line 36. That total is $37,153, and where did we get that? Well, we went to the IRS tax tables and for a single taxpayer looked up how much taxable income Diana would need to pay on $155,156. The total answer to that is $37,153. And Diana can pay the lower of the amount shown on line 36 or line 35. And of course, line 35 is the lower number. We carry that amount to line 37, $29,530, and enter that amount on line 46 of her Form 1040. The next step is to look at her withholdings. She had $25,000 withheld. It's not enough, so she owes $4,568. One other worksheet I did want to go over with you is the Section 1250 Gain Line 19 worksheet. I've always considered this to be a rather pointless worksheet. I mean, if you know in your head the amount of unrecaptured gain, you don't really need it. If you read through the worksheet, which we are including in the answer key for you, it simply tells you where to enter this amount and or what to do with this amount in terms of tax treatment. And the bottom line is it's subject to a maximum tax rate of 25%, and we've properly entered that on the capital gain worksheet. So that concludes the review of the Session 15 homework assignment. At this point, it is now time to push pause on video playback, go to the Learning Management System, and take the Session 15 quiz. When you are finished taking the Session 15 quiz, please resume video playback, and I will begin teaching you the Session 16 lecture. And let's get going now with the Session 16 lecture. Today's topic covers two important areas: selling your home and installment sales. We're going to begin with selling your home, and of course there are a couple of publications as usual that you probably should take a look at. The first one is publication 523 for selling your home, and then also publication 537 on installment sales. There is a recap or a summary of some of the content of today's session in Pub 17 on pages 106 to 112. And beginning with sale of home. There is room for some confusion when it comes to selling your home. The rules for sale of home changed completely beginning in 1997, and many homeowners currently own homes today that they bought under the rules that existed in 1997 and earlier years. Did you file Form 2119 to postpone gain on the sale of your home before May 7, 1997? Because prior to May 7, 1997, the gain on the sale of your home was fully taxable. However, if you bought a replacement home that was equal to or greater in value than your old home, you would have filed Form 2119 to postpone your gain. Postponement of gain on the sale of your home effectively reduced your cost basis in your new home. This is relevant today if you are trying to calculate the gain on the sale of a home for which you previously filed Form 2119. Now, there also used to be a once-in-a-lifetime exclusion of $125,000 on the sale of a home for taxpayers aged 55 or older. The once-in-a-lifetime exclusion on the sale of home for taxpayers aged 55 or older has been rescinded, and this exclusion is no longer applicable to the sale of a home after May 6, 1997. If you previously claimed this exclusion, you are not prevented from claiming the exclusion that exists under the rules today. So what were the rules, or what are the rules for sale of home after May 6, 1997? Well, if you sold your home in 2010, you can exclude up to $250,000 of gain or $500,000 of gain if you are married and filing a joint return. Excluding gain on the sale of a home under Section 121. You qualify to exclude gain on the sale of your main home if you owned and lived in your home for 2 of the last 5 years. Your main home can be any of the following: a houseboat, a mobile home, an apartment, or a condominium. Your main home is generally the home you live in most of the time. If you own 2 or more homes, only one of those homes is your main home. So I have had the question asked of me, well, how do you decide what is your main home if you have 2 homes? Well, clearly the home where you are registered to vote, where you do your banking, where you spend the majority of your time, or the most important aspects of your social and family life is probably your main home. And it is possible that you have 2 main central focuses of your life, 2 different homes that you share just about equally even. But only one of those can be your main home, and really the facts and circumstances are going to establish which of those is your main home. For example, recently one of my tax preparers came to me and said, well, I have a client who sold their vacation home in California. Is there any way we could treat that as their main home? And my answer was, well, are they registered to vote there? Is their driver's license registered to that address? Or is it really the address here in their hometown of Portland, Oregon? And the answer, of course, was no, they live in Portland, Oregon, and everything is in Portland, Oregon, and they weren't going to be able to swing convincingly, at least in my mind, calling their vacation home in California their main home, when clearly all the facts and circumstances established that it was not their main home. Reduced maximum exclusion. Generally, you may only claim the exclusion for gain on the sale of your home once every 2 years. However, you may still be entitled to claim a partial exclusion if you sold your home sooner than 2 years after you claimed the exclusion, or sooner than 2 years after you purchased your home if you sold your home because your health changed, you changed your place of employment, or other unforeseen circumstances. If you qualify for the reduced exclusion, you may claim the exclusion on the sale of your home that is prorated for the length of time you lived in your home during a 2-year period. And here's an illustration. Sam bought his home on 10/10 of 2008 for $150,000. On 1/10 of 2010, he moved to Arizona to begin working at a new job. He sold his home for $180,000. Sam can exclude all of the gain on the sale of his home as follows. He takes the number of months in 2 years, which is 24, and he divides that into the number of months he owned and occupied his home, 15. He then multiplies that by the maximum exclusion amount of $250,000. So 15 over 24 times $250,000 equals $156,250. The $156,250 reduced exclusion amount is more than Sam's gain on the sale of his home. He does not need to pay tax on his gain, even though he did not meet the 2-year rule. So how to figure the gain or loss on the sale of your home? To accurately figure gain or loss on the sale of your home, you must maintain accurate records. If you live in your home for 20 years, you should save your receipts for 23 years. For the 20 years that you lived in your home, and for 3 years after you sell it. So what records should you keep? Well, you should keep all of the following: receipts or other written records of any improvements you made to the home, including landscaping, a new roof, new plumbing, new wiring, improvements like room additions, decks, patios, fences, etc., remodeling costs for kitchens, baths, basements, etc., closing costs from the purchase and sale of your home and from any refinances or home equity loans used for home improvement. Records for any depreciation you may have claimed for business use of your home. And here is an illustration. Mr. and Mrs. Harper bought their home in 1988 for $170,000. Their closing papers show that they paid an additional $1,500 in closing costs. On 5/10 of 96, they refinanced their home for $150,000 and used all of the proceeds of the new loan to remodel and make other improvements to the home. They paid $1,500 in closing costs for that refinance. Then on 8/10 of 2005, they refinanced their home again for $250,000. This time, the proceeds were used to pay off credit cards and car loan debt, but $5,000 was spent to replace the roof. They paid $2,500 in closing costs at that time. Then on 8/9 of 2010, they sold the home for $285,000. They paid $17,100 in real estate commissions to their agent and another $2,500 in closing costs. To figure the gain on the sale of Mr. and Mrs. Harper's home, we must add up the following amounts. The purchase price is $70,000. Closing costs on purchase of $1,500, home improvements in 1996 of $80,000, closing costs in 1996 of $1,500, and home improvement in 2005 of $5,000. That gives us an adjusted basis of $158,000. And if you'll note here, on the 2005 refinance, they did pay $2,500 in closing costs, but really the refinance was about paying off credit card and car loan debt. And so we've not taken any of those closing costs and added them to basis. But we did take the actual $5,000 that was spent to replace the roof. We then looked to the gross sales price of the home, which was $285,000, and the closing costs on the sale were $2,500. Commissions on the sale were $17,100, so that gives us an amount realized from the sale of the home of $265,400. So we figure the net profit on the sale by taking $265,400 of realized amount from the sale and subtracting from that the cost basis or the adjusted basis in the home. When we do that, we get $107,400 of gain on the sale. Now, since Mr. and Mrs. Harper refinanced their home in 2005 for $250,000, their loan balance at the time they actually sold was $243,000. The net sales proceeds of $265,400 would pay off the $243,000 mortgage and leave them with $22,400 really of cash left, or amount that they might get a check from at the end of the sale. But no tax is going to be owed on the $107,400 of realized gain because it is less than the $500,000 of excludable gain allowed under the law. Now, please note that many people are easily confused about the difference between how much money they actually receive from the sale of their home and the amount of gain they realize from the sale. The gain realized on sale has little to do with the amount of cash left when the sale is complete. This is true for sale of your home as well as sale of business assets or other income-producing property. So how to report the sale of your home? Generally, if you meet the rules for excluding the entire gain from the sale of your home, there is no need to report the sale of your home on your tax return. However, you should report the sale of your home on your tax return if either of the following is true. Number 1, you received a Form 1099-S Or 2, your gain from the sale of your home is greater than your exclusion amount. Now, prior to 1998, taxpayers were required to report the sale of their home on Form 2119. Form 2119 is no longer in use. If you are required to report the sale of your home, you should use Schedule D. If you claimed depreciation on your home after May 6, 1997, you should report any recovery of depreciation on Schedule D, line 19, and then complete the Section 1250 gain worksheet. Now, here is an illustration of a 1099-S, and one of the things that you should be aware of as a tax preparer is that if your client has a 1099-S, you have to complete Schedule D. 1099-S equals Schedule D. 1099-S equals Schedule D. 1099-S equals Schedule D. And the reason I'm saying that over and over again is, well, I supervise tax preparers, and somehow, for some reason, lots of preparers tend to see this statement and then go, well, there's no gain. I don't need to file this on the return because there was no gain. The problem is that when the IRS sees that a 1099-S is issued, they don't know that there's a basis or that there's an excludable gain. They only know that a 1099 was issued, and it shows a big number, and they're going to want tax on that number until a Schedule D is filed to show that there was no taxable gain. So essentially, if no 1099 is issued, then it is likely the reason it was not issued is because the gain is not taxable. But sometimes a 1099-S is issued even when the gain is not taxable. And therefore, anytime you see that form, you should prepare a Schedule D, and I'm going to show you how you go about doing one right here. On February 5, 2010, Peter and Betty Homemakers sold their home for $795,000. The homeowners purchased their home on 3/5 of 1968 for $20,000. Weren't those the days? Over the years, they spent $12,250 on improvements to their home and paid $40,000 in commissions and other selling expenses. They received the following Form 1099-S from their title company. Calculate and report the homeowner's taxable gain from the sale of their home as follows. Well, we begin with looking at the amount of proceeds, 1099-S, and they equal the sales price, $795,000. So how do we figure their adjusted basis in the home? Well, we look to their purchase price of $20,000, we add in the cost of improvements, and we also add in the selling expenses. That gives us an adjusted basis in the home of $72,250. We then look over at the gross proceeds from the sale, which are $795,000, and we subtract out the adjusted basis of $72,250, and we're left with a gain on the sale of $722,750. How much of that will be taxable? Well, since they owned and occupied the home for 2 out of the last 5 years, and they're filing a joint return, we're going to get a $500,000 exclusion. And that means that only $222,750 of gain is taxable to them. So here is how we would complete Schedule D for the homeowners. And of course, this is a long-term sale, so it is reported in Part 2 of Schedule D. We begin on line 8 by entering main home, the date acquired, the date sold, the sales price, the adjusted basis that we figured for the home, and the gain realized on the sale. $500,000 of gain is not taxable under Section 121, so we enter Section 121 exclusion and negative $500 in the gain line, or negative $500,000 on the gain line. Then we end up with a net taxable gain of $222,750. The next topic we're going to talk about is recapturing depreciation on the sale of your home. And while most people can take advantage of the $250,000 exclusion or $500,000 exclusion in the case of married filing joint, there are still instances where the sale of the home can result in a taxable gain. If you claim depreciation on your home after May 6, 1997, you must recover depreciation you claimed on your home to the extent of the amount of depreciation you claimed or your net gain, whichever is less. The good news for many homeowners is that depreciation claimed for business use of your home prior to May 7, 1997 does not need to be recaptured. And here's an illustration. Chloe Sullivan sold her home on June 30th of 2010 for $165,000. Chloe used her home for business and claimed allowable depreciation deductions on her home totaling $4,000. Chloe's basis in her home is $100,000, and she purchased her home on October 10, 2004. Chloe must recover depreciation she claimed after May 6, 1997. Depreciation she claimed after May 6, 1997 is reported on Schedule D, line 19. Complete Schedule D for Chloe as shown on the next 2 pages as follows. So we begin by looking at the sale of Chloe's home and the fact that we report that on line 8. So just as with the homeowners, we're going to enter a description of the property sold, the purchase date, the sales price, the cost, and the gain. And in this case, we have a gain of $65,000. Since Chloe must recover $4,000 of depreciation that she previously claimed on her house, she has to reduce her exclusion amount by $4,000. So $65,000 is the gain on the sale, and because she owned and occupied her home for 2 out of the last 5 years, she is allowed to exclude that gain from taxation, but not any portion of the gain that is attributable to depreciation after May 6, 1997. How much was there? $4,000 of non-excludable depreciation. So she subtracts that $4,000 of non-excludable depreciation from the sales or from the net gain on the house of $65,000, and that leaves her with an excludable gain of $61,000. So let's see how we work with that. Well, we go over to the Schedule D again, and in Part 2 we write main home. We then enter the date acquired, the date sold, and the sales price and the cost, giving us a gain of $65,000. How much are we allowed to exclude under Section 121? We are allowed to exclude $61,000. That leaves us with a gain of $4,000. We carry the $4,000 to line 16, and we also enter $4,000 on line 19 because that is the amount of gain that is Section 1250 gain. We then carry the total gain of $4,000 and enter it on line 13 of Form 1040. And of course, the $4,000 that is reported on line 13 is going to be subject to a maximum capital gain rate of 25%. So we're going to have to do the capital gain rate worksheet in preparing Chloe's tax return to determine how much tax she needs to pay on that gain. Now, what happens if you sell your home and you used your home for business? Well, if you used your property partly as a home and partly for business or to produce rental income, the treatment of any gain on the sale depends partly on whether the business or rental part of the property is a part of your home or separate from it. If the part of your property used for business or to produce rental income is within your home, such as a room used as a home office for a business, you do not need to allocate the basis of the property and the amount realized between the business part of the property and the part used as a home. You do not report the sale of the business or rental part on Form 4797, and this is true whether or not you were entitled to claim any depreciation deductions. You must recover and pay tax on any part of gain equal to any depreciation deductions allowed or allowable after May 6, 1997. And here's an example. Ray sold his main home in 2010 at a $30,000 gain. He meets the ownership and use test to exclude the gain from his income. However, he used part of the home as a business office in 2009 and claimed $500 of depreciation. Because the business office was part of his home and not separate from it, he does not have to allocate the basis and amount realized between the business part of the property and the part he used as a home. In addition, he does not have to report any part of the gain on Form 4797. He reports his gain, exclusion, and taxable gain of $500 on Schedule D, line 19, Form 1040. But let's just change the facts a little bit. Assume everything's the same as in Example 1, except that Ray was not entitled to claim depreciation deductions for the business use of his home. Since Ray did not claim any depreciation deductions, he can exclude the entire $30,000 gain. Now, what happens if you have your home divided into 2 clearly definable areas, and one of those is used for personal and one of those is used for business? You may have used part of your property as your home and a separate part of it for business or to produce rental income. Examples are a working farm on which your house was located, an apartment building in which you live in one unit and rented the others, or a store building with an upstairs apartment in which you lived. The use test is not met for the business part in this type of situation. You cannot exclude gain on the separate part of your property used for business or to produce rental income unless you lived in that part of your property for at least 2 years during the 5-year period ending on the date of the sale. If you do not meet the use test for the business or rental part of the property, you must allocate the basis of the property and the amount realized upon its sale between the business or rental part and the part used as a home. Here is a third example. Jessica is self-employed and lives in a duplex which she owns. Jessica lives in the larger part of the duplex, which is 60% of the building, and runs her business from the smaller part of the duplex, which is 40% of the building. Jessica has owned and occupied her duplex for the past 4 years. She operated her business from the duplex for the past 4 years as well. Jessica sold her home during 2010. She can exclude the gain only on the 60% portion of the duplex that was her home. She must report any gain or loss on the sale of the business use portion of the duplex that was used for her business. So assume Jessica paid $200,000 for her home and that she sold it for $300,000. She must multiply her $100,000 gain by 60%. She can exclude $60,000 from her income. However, she must include $40,000 as a taxable gain. She must also recapture and pay tax on any depreciation she claimed on her duplex after May 6, 1997. Tax planning for the sale of your home where there is non-qualified use. Now, because of the exclusion rules on sale of the home and the fact that you only need to live in your home 2 out of a 5-year period to be able to exclude the gain, there has been an extended period of time where people actually could own multiple properties, and they would live in one for 2 years and then sell it and exclude the gain, and then move into the other one and live in it for 2 years and exclude the gain, even if they had owned the homes for many, many, many years, including for rental purposes. So prior to 2009, a common tax-saving strategy was to convert a non-qualified home that was used for rental, vacation, or investment purposes into your main home. The 2 of 5-year rule could then be met if you made the rental or vacation home your main home for at least 2 out of 5 years. This tax-saving strategy no longer applies if the gain from the sale or exchange of your home is allocable to periods of non-qualified use after 2008. Generally, non-qualified use means any period in 2009 or later where neither you or your spouse or your former spouse used the property as a main home. A period of non-qualified use does not include any period of the 5-year period ending on the date of sale or exchange that is after the last date you or your spouse used the property as a main home, or to any period not to exceed an aggregate period of 10 years during which you or your spouse is serving on qualified official extended duty as a member of the Uniformed Services, as a member of the Foreign Service of the United States, or as an employee of the intelligence community, and any other period of temporary absence not to exceed an aggregate period of 2 years due to a change of employment, health conditions, or other unforeseen circumstances as may be specified by the IRS. So let's see what they mean by this, or let's see what IRS means by this. We need to go about allocating gain on the sale of our home between qualified and non-qualified periods of use. To figure the gain that is allocated to the period of non-qualified use after 2008, multiply the gain by the following fraction: the total non-qualified use during the period of ownership in 2009 or later, divided by the total period of ownership. Next is an example that I've pulled from publication 523, an example of a fully excludable gain. And actually, if you go to publication 523, it's got page after page of illustrations. So I'm going to give you a couple of illustrations here today of when we have a non-taxable gain and also of when we have a taxable gain. But if you are in a situation where you're still not clear on this and you want to read about other illustrations, please go to publication 523 where the IRS has a lot more listed. On May 29, 2004, Amy bought a house. She moved in on that date and lived in it until May 31, 2006, when she moved out of the house and put it up for rent. The house was rented from June 1, 2006 to March 31, 2008. Amy moved back into the house on April 1, 2008 and lived there until she sold it on January 29, 2010. During the 5-year period ending on the date of the sale, which is January 31, 2005 through January 29, 2010, Amy owned and lived in the house for more than 2 years, as shown on the following table. So we look at that 1/31 of 2005 through 5/31 of 2006 and show that she lived in the home for 16 months. We then have 22 months where she did not live in the home and rented it out. That is followed by another period between 4/1 of 08 and 1/29 of 10, totaling 22 months where the home was used for personal purposes again. So out of the 5-year period, 38 months were personal use, 22 months were rental use. Amy can exclude up to $250,000 of gain. However, she cannot exclude the part of the gain equal to any depreciation she claimed or could have claimed while the house was being rented after May 6, 1997. So this period of time right here, June 1, 06 through 3/31 of 08, the property was used as a rental. Depreciation would be applied to that particular time when it was a rental, and whatever depreciation was claimed during that period of time would have to be recovered, and tax would be paid upon it. And here is an example of how we would figure a partially excludable gain. June Cleaver is single. She bought her home on May 1 of 2000 and lived in the home until December 31, 2008, when she moved out and rented it out. June rented her home until December 31, 2009. Then she moved back into the house and lived there until she sold it on June 1st of 2010. June can exclude gain on the sale of her home because she owned and lived in the home at least 2 of the 5 years for the period ending on the date of sale. June's records show the following. Purchase price was $100,000, title search $500, back taxes paid for the prior owner of $1,500, improvements for remodeling the kitchen of $10,000, a selling price of $270,000 minus selling expenses including commission, and depreciation claimed after May 6, 1997 of $33.45. So we're going to use the following worksheets to figure the adjusted basis of the home that she sold. The purchase price was $100,000, and to that we add the title search, back taxes paid for the prior owner, and improvements. And we get a basis before depreciation of $112,000. We then subtract out the depreciation that she claimed to get an adjusted basis on the home of $108,655. Now, the IRS provides 3 different worksheets which you can use to figure the taxable gain from the sale of your home. You use Worksheet 1 to figure the adjusted basis of the home that was sold. In this case, we're doing figuring the adjusted basis for June Cleaver. She paid $100,000 for the home. She paid for a title search costing $500. She had back taxes that were paid for the prior owner of $1,500. She made improvements to the home, remodeling the kitchen of $10,000, and her basis before depreciation is $112,000. She subtracts out the depreciation that she claimed, and that gives her an adjusted basis in the home of $108,655. So we begin on the worksheet with all of this same information, and the worksheet has you organized as it follows. We enter the purchase price of the home. We enter the amount of any postponed gain from prior to May 7, 1997. In the case of June Cleaver, there was none. So we carry the amount on line 1 to line 3, $100,000. We then add in closing costs, including legal fees, and amounts that the seller agreed to pay for the buyer, that is, the property taxes. We add up the amount on line 4, and we get $2,000. We also look at the cost of any improvements that June made to the property during the time she owned it, which was $10,000, and that gives her total increases to basis of $12,000. Added to the purchase price, we have $112,000. Next, we look to see how much depreciation was allowed or allowable on the home during the time she owned it. That was after May 7, 1997, and that totaled $3,345. We enter $33.45 on line 12, subtract that from line 9, and we get $108,655. Now it's time to use Worksheet 2, Part 1 to figure the amount of gain from the sale. We have a selling price on the home of $270,000. We subtract out $18,000 of selling expenses, and then we subtract out the adjusted basis in the home. That gives us a gain on the sale of $143,345, and this is the amount that we would actually carry to Schedule D and enter on line 8 as a taxable gain. So Worksheet 2, Part 1 asks you to begin by entering the selling price of the home. You subtract out expenses of the sale. You get a net result on line 3 of $252,000. You then subtract out the adjusted basis in the home that we figured up here on line 13, and we arrive back at that same amount of $143,345. Next, we use Worksheet 2, Part 2 to figure the exclusion amount and the taxable gain. We subtract depreciation from the gain on the sale. So we have a gain on the sale of $143,345, and we're going to pull the portion of that gain that it was attributable to depreciation, and we get $140,000 of gain that is actually capital gain. We then need to figure the percentage of non-qualified use of the home. The number of the days that the home was rented after 2008 is 365 days, and the total number of days that June owned the home is 3,684 days. So that gives her a percentage business use of 0.099%, just under 1%. We figure the portion of the gain that is taxable due to non-qualified use after 2008 as follows. We take the gain on the home without depreciation, and that was $140,000. We then multiply that by the business use, which is 0.099, and we get $13,860. $13,860 of gain is going to be taxable to June because it is gain that is attributable to non-qualified use after 2008. Now we figure the excludable gain. The gain on the home without depreciation was $140,000, and we have to subtract out the gain that is allocated to non-qualified use. That gives us gain that is excludable in the amount of $126,140. We're going to carry $126,140 over to line 8 and enter that as a negative number in column F on Schedule D. Finally, we figure our taxable gain. Well, our taxable gain is going to be any gain allocated to depreciation after May 7, 1997, plus any gain allocated to non-qualified use. We take the $33,445 and the $13,860, and we get total taxable gain of $17,205. So post-May 6, 1997, depreciation is taxable, and we're going to include $3,345 on lines 15 and 19 of Schedule D. The gain that is attributable to non-qualified use after 2008 is taxable, and it will be included in the amount on Schedule D, line 15. So in reality, $17,205 will be reported on lines 15 and 16 of Schedule D, and then on line 19 of Schedule D, we will pull out $3,345. So let's see how Worksheet 2, Part 2 works. We begin by entering the amount of depreciation claimed on the property. We then enter the gain on the home prior to subtracting out depreciation, and we enter in the number of aggregate days of non-qualified business use. And finally, on line 9, we enter the amount of depreciation previously allowed or allowable. On line 10, we show the percentage business use, and then we multiply that amount by the amount on line 7 to get $13,860. The next step is to subtract line 11 from line 7. And when we do that, we get $126,140. Now we look at the amount of gain that June can exclude because this was her main home for at least 2 out of the last 5 years. The maximum gain she can exclude is $250,000, or the amount shown on line 12. So the most she can exclude is $250,000, but if that is less than the amount on line 12, we then enter the amount on line 12. So this is the amount she will claim as a Section 121 exclusion. We then take the amount of gain that is not excludable and add that to the depreciation, and the instructions right here tell you to enter this amount on line 15 of Schedule D and on line 12 of the unrecaptured Section 1250 gain worksheet. And here is June Cleaver's finished Schedule D, taking all of these numbers and putting them in the appropriate place. Since this is a long-term asset that was sold, we're going to enter the sale in Part 2, and we begin by describing the entry as a main home sale. We enter the date acquired, the date sold, the sales price, the cost or other basis that we figured, and the net gain on the sale. We then look to see what portion of that gain is excludable, and the portion of the gain that we can exclude is $126,140. We then subtract $126,140 from the gain, and we have $17,205. We carry $17,205 over to line 16, and then we pull the portion of $17,205 that is for depreciation and enter that on line 19. So $33,445 is entered on line 19. So to summarize, line 15 includes $13,860 of capital gain plus $3,345 of post-May 6, 1997. Both amounts are taxable and are entered on line 16. $13,850 of capital gain is taxed at a capital gain rate of either 0 or 15%, depending on the income level of the taxpayer. And the amount shown on line 19 includes $3,345 of depreciation that was recovered on the sale of the property. It is taxed at a maximum rate of 25%. And the first password of the day that I am going to give you today is the password to open the Session 15 homework answer key. The password is Pitcairn, Pitcairn, as in the famous Pitcairn Island from Mutiny on the Bounty. Recapture of first-time homebuyer credits is the next topic of the day. There are 3 different homebuyer credits that were available to certain first-time homebuyers and certain long-term homeowners during tax years 2008, 2009, and even during 2010. Some individuals who claimed the credits are required to pay back some or all of their credits in certain situations. Firstly, figuring the annual repayment amount for certain homes that were bought in 2008. If you claimed the credit for a home you bought in 2008, you generally must begin repaying it with your 2010 tax return. Beginning in 2010, you must complete Form 5405 and enter $500 on Form 1040, line 59. You may be required to pay more than $500 for 2010 if you claimed a homebuyer credit for a home you bought in 2008 and you sold the home in 2010 or the home stopped being your main home in 2010. So essentially what happened in 2008 is the government came out with a first-time homebuyer credit in the amount of $7,500. That $7,500 was actually a loan, an interest-free loan to the taxpayer who bought a qualifying first home. And the conditions of that particular $7,500 credit was that the government essentially refunded the credit to that taxpayer on their 2008 tax return. But the conditions of the credit are that it was a loan, and that beginning in 2010, the taxpayer must repay $500 of that credit each year for 15 years. But if the home stops being the main home within a certain frame of time, then the full remaining amount of the credit might have to be repaid all at once. So let's talk about repayments of homebuyer credits that were claimed for 2008 or 2009. You must repay all or some of the homebuyer credit that you claimed for 2008 or 2009 if you disposed of or ceased using as your main home the home for which you claimed the credit, and any of the following situations apply. Number 1, you sold the home, including through foreclosure or repossession, to a person who was not related to you and had a gain on the sale. If you sell the home to someone who is not related to you, the repayment in the year of sale is limited to the amount of gain on the sale. The amount of the credit in excess of the gain does not have to be repaid. Or you sold the home to a related person. Or you converted the entire home to a rental or business use. Or you still own the home but no longer use it as your main home. Or your home was destroyed, condemned, or disposed of under threat of condemnation, and you do not plan to acquire a new home within the 2 years of the event. To determine how much of your credit you must repay, complete Form 5405 Gain or Loss Worksheet shown on page 19 of this manual. No repayment of the credit is required if the following exceptions apply. Your home ceased to be your main home because you or your spouse, if married, was a member of the Uniformed Services or Foreign Service or an employee of the intelligence community, and you or your spouse received government orders to serve on qualified extended duty service. Or you sold, including through foreclosure or repossession, the home to a person who is not related to you, and you did not have a gain on the sale. Use Form 5405 Gain or Loss Worksheet to determine if you have a gain. When figuring the gain, reduce the adjusted basis of the home by the amount of the credit. If you do not have a gain, you do not have to repay the credit. Or you transferred the home to your spouse or ex-spouse as a part of a divorce settlement. The responsibility for repayment of the credit is transferred to your spouse or ex-spouse. If none of the allowable exceptions apply and your spouse or ex-spouse sells the home or it ceases to be his or her main home during the 36-month period beginning on the purchase date, he or she is responsible for repaying the credit. Or your home is destroyed, condemned, or disposed of under threat of condemnation. In this situation, you do not have to repay the credit if you purchase a new home within 2 years of the event and you owned and use it as your new main home during the remainder of the 36-month period. or the taxpayer who claimed the credit died in 2010, no repayment of the credit is required of the deceased taxpayer. Or you die, but if you claimed a credit on a joint return and then you die, your surviving spouse would be required to repay his or her half of the credit if during the 36-month period beginning on the purchase date, he or she disposes of the home or it ceases to be his or her main home and none of the allowed exceptions apply. How to repay the homebuyer credit. If you received the 2008 or 2009 first-time homebuyer credit when you purchased your home, you may have to recapture all or a portion of the amount you received. The 2008 first-time homebuyer credit is intended to be repaid by the taxpayer over a period of 15 years at a rate of $500 per year, beginning with tax year 2010. However, if your home ceases to be your main home before the 15-year period has elapsed, you must include all remaining annual installments as additional tax on the tax return for that year. Your home ceases to be your main home if you sell the home, convert the home to business or rental property use, or the home is destroyed, condemned, or disposed of under threat of condemnation. If you sell your home or otherwise stop using your home as your main home, you will need to file Form 5405 First-Time Homebuyer Credit and repayment of the credit with your return. If you sell your home to a person who is not related to you, the recapture shall not exceed the amount of gain, if any, on such sale. And here is an example. Johnny sold too soon received $7,500 as a 2008 first-time homebuyer credit. He purchased his home on July 1, 2008 for $250,000. His adjusted basis in the home is $242,500. That's $250,000 purchase price minus the $7,500 first-time homebuyer credit. Johnny sold the home on August 3, 2010 for $250,000. Expenses totaled $4,500. So his net gain from the sale is figured as follows. You begin with the purchase price of the home and subtract out the first-time homebuyer credit that he claimed. That gives you an adjusted basis, or gives Johnny an adjusted basis of $242,500. We then look to the sales price of the home. Then we subtract out the selling expenses and the adjusted basis of the home from the selling price. When we do that, we get a gain on the sale of $6,000. Now, the IRS provides the following worksheet in the instructions for completing Form 5405. It essentially takes all of the same information, arranges it a little bit differently, and comes out with the same answer. We take the selling price of the house and enter that on line 1. We then subtract out the selling expenses of $4,500 to get the amount realized from the sale of the home. We then take the adjusted basis of the home, which is the cost of the home minus the credit, and enter that difference on line 6. We then subtract line 6 from line 3, and we get that same $6,000 amount. So how do we treat that on Johnny's tax return? Well, we complete Form 5405, and on line 11, we begin by entering the date of sale, which is August 3, 2008. Then on line 13, we check the box that says, box A, that I sold the house to a person who was not related to me, and I had a gain on the sale, as figured using the worksheet and the instructions. Well, the worksheet and the instructions gave us a gain of $6,000. So we show on line 14 the amount of first-time homebuyer credit claimed. We then show the gain on the sale of the home, and we enter the smaller of those two numbers on line 16. The amount shown on line 16 carries over to Form 1040 and is entered on page 2, line 59. We check box C for Form 5405, line 16, and enter the $6,000 on the line. So Johnny completes Form 5405, page 2, to figure the amount of 2008 homebuyer credit that he needs to repay. Since his gain is less than $7,500, Johnny does not need to repay the full credit. Instead, his repayment is equal to his gain of $6,000. Carry the tax owed from the recapture to Johnny's Form 1040, line 59, and check box C, then enter the amount, $6,000, on line 59. So that concludes our discussion on sale of home. Now we're going to move on to the next topic of the day, which is installment sale income. So what exactly is an installment sale? Well, an installment sale is a sale of property where you receive at least one payment after the tax year of the sale. The installment sale rules do not apply, however, to the sale of inventory. General rules. If a sale qualifies as an installment sale, the gain must be reported under the installment sale method unless you elect not to use the installment method or you use an accrual method of accounting. Figuring the installment income. Each payment on an installment sale usually consists of the following three parts. Number 1, interest income. Number 2, a return of your adjusted basis in the sale. And number 3, gain on the sale. For each year you receive a payment on the sale of your property, you must include the interest part in your income as well as the part that is your gain on the sale. You do not report in income the part that is the return of your basis in the property. Interest income. You must report interest income as ordinary income. Interest is generally not included in a down payment. However, you normally would treat part of each later payment as interest, even if it is not called interest in your agreement with the buyer. Return of basis and gain on sale. The rest of each payment is treated as if it were made of two parts. One part is a tax-free return of your adjusted basis in the property, and the other part is your gain. Figuring the gain on the part of your repayment. To figure what part of any payment is gain, multiply the payment less interest by the gross profit percentage. Use the following worksheet to figure the gross profit percentage. And this worksheet, of course, is for the instructions for Form 6252. And this particular worksheet has always been a favorite worksheet in the Oregon Tax Board exams. Now, most people taking this course, of course, are studying for the IRS tax preparer exam. And I could not tell you at this point whether the IRS is going to have you figure the gross profit percentage on an installment sale. But I can just tell you that the Oregon Tax Board has tended to test on this particular worksheet, and year after year, Form 6252 installment sale income is a most frequently missed question on the Oregon exam. So I would recommend, whether you're in Oregon or in any other state, you study this worksheet and get familiar with how to complete it, because in the real world of tax preparation, installment sales aren't hugely common, but when they do happen, you really should have a clue about what you need to do. So we begin on the worksheet by entering the selling price of the property. We then enter the adjusted basis in the property and add in any selling expenses. We then enter in any depreciation recapture. We then take lines 2, 3, and 4 and add them together. This is the adjusted basis in the property. We then subtract line 5 from line 1, and if this amount is 0 or less, we enter 0, and this is the gross profit. If the amount entered on line 6 is 0, stop. There is no profit, so you have no installment method that would apply. Then on line 7, we enter the contract price for the property, and we divide line 6 by line 7. This is the gross profit percentage. So reading the instructions for the worksheet will only make sense if you actually have some numbers to put on it. So we'll show you some illustrations in just a minute. So looking at this worksheet, in looking at the worksheet, you have to understand the definition or the meaning of each item shown on the worksheet. So what does it mean when it says enter the selling price of the property? Well, the selling price is the total cost of the property to the buyer, and it includes any money, the fair market value of any property you are to receive, any debt the buyer assumes or pays on the property that is sold, and any selling expenses that the buyer pays for the seller. But the selling price does not include interest, whether it is stated or unstated. Line 2 is asked for the adjusted basis in the property, and what is that? Well, the installment sale basis is comprised of 3 parts: the adjusted basis, the selling expenses, and the depreciation recapture. You must figure your installment sale basis before you can calculate your gross profit percentage. Contract price. The contract price equals the selling price minus mortgages, debts, and other liabilities assumed or taken by the buyer, plus the amount by which the mortgages, debts, and other liabilities assumed or taken by the buyer exceed your adjusted basis for installment sale purposes. Your gross profit percentage is the amount of each payment that is to be reported as gain from the sale. The gross profit percentage generally remains the same for each payment you receive. However, if you agree to reduce the selling price at a later time, you will have to refigure your gross profit percentage for the remaining payments. Recapture of depreciation for Section 1245 property. If you report the sale of property under the installment method, any depreciation recaptured under Section 1245 is taxable as ordinary income in the year of sale. This applies even if no payments are received in that year. If the gain is more than the depreciation recapture income, report the rest of the gain using the installment method rules. Recovery of gain on Section 1250 depreciation. Gain on the sale of Section 1250 property, generally real estate, can generally be reported using the installment method, provided the property was held for more than 1 year and was depreciated using the straight line method. If the property was held for 1 year or less, all gain is taxable as ordinary income. And here's an illustration of what we mean on how we recapture depreciation on the sale of a property under the installment method, and the sale of the property involves both Section 1245 gain and Section 1250 gain. And here it is. Farmer Brown sells his farm under an installment agreement. His adjusted basis in the land and the buildings is $700,000, with accumulated depreciation of $80,000. As a part of the sale, Farmer Brown also sells farm equipment with a basis of $100,000 and accumulated depreciation of $70,000. The sales price is allocated as follows: $1 million for the farmland and buildings and $80,000 for the equipment. The buyer's combined down payment and installment principal payments to Farmer Brown total $40,000 for the year. Figure Farmer Brown's taxable income for the year of sale as follows. First, we look at the Section 1250 property. The farm itself has sold for $1 million, and the original cost of the farm was $700,000. Depreciation claimed on farm buildings was $80,000, and that gives an adjusted basis in the farm of $620,000. The farm then sells for $1 million. We subtract out the adjusted basis, and we get a gain on the sale of $380,000. Now, the gain on the sale of the farm is allocated as follows. Section 1250 gain from depreciation recovery is $80,000, and long-term capital gain is $300,000. Next, we look to the Section 1245 property. That was the farm equipment, and it had a sales price of $80,000. The original cost basis in that farm equipment is $100,000, and $70,000 of depreciation was previously claimed, leaving an adjusted basis in the farm equipment of $30,000. We take the sales price of $80,000, subtract out the adjusted basis of $30,000, and we get a gain, a Section 1245 gain of $50,000. So even though Farmer Brown received only $40,000 of payments during the year, he must report $50,000 of ordinary income from the sale because he must recapture all Section 1245 gain in the year of sale. No installment income is reported in the year of sale on the farm. Reporting installment sale income on Form 6252. You use Form 6252 to report an installment sale in the year of the sale and also to report the payments received in years after the year of sale. Attach the form to your tax return each and every year that you receive a payment. Form 6252 will help you to determine the gross profit, contract price, gross profit percentage, and how much of each payment received during the tax year that you should include in income. Form 6252 is divided into the following parts. Part 1 is completed for the year of sale, and it is used to figure the gross profit and the contract price. Part 2 is used to figure the installment sale income, and it is completed for the year of sale and for any year you receive a payment or are considered to have received a payment. Part 3 is completed if you sell the property to a related person. For the year of sale, you should answer the questions at the beginning of the form and then complete Part 1 and Part 2. Line 3 asks if you sold the property to a related party. If you answer yes to the question on line 4, complete Part 3. For later years, answer the questions at the beginning of the form and then complete Part 2 for each year in which you receive a payment on the sale. Payments received including payments considered received. You must figure your gain each year on the payments you receive or are treated as receiving from an installment sale. These payments include the down payment and each later payment of principal on the buyer's debt to you. In certain situations, you are considered to have received a payment, even though the buyer does not pay you directly. This occurs if the buyer assumes or pays any of your debts, for example, mortgages or taxes owed, or pays any of your expenses, for example, sales commissions. Seller-financed mortgage. Special reporting procedures apply if you finance the sale of your home to an individual. When you report interest income received from a buyer who uses the property as a personal residence, write the buyer's name, address, and Social Security number on line 1 of Schedule B for Form 1040 or 1040A. Schedule D. Enter gain from the sale on Form 6252 and on Schedule D, line 19. If your gain from the installment sale qualifies for long-term capital gain treatment in the year of sale, it will continue to qualify in later years. Your gain is long-term if you owned the property for more than 1 year when you sold it. Form 4797. An installment sale of property used for business or rent or for production of royalty income may result in a capital gain, an ordinary gain, or both. All or part of any gain from its disposition may be ordinary gain from depreciation recapture. Use Form 4797 to report these transactions and to determine the ordinary or capital gain or loss. So essentially, if you sell your home, you typically would not complete Form 4797. You would only complete Schedule D and Form 6252. But if you sell your business or business assets under the installment method, then you would report the sale of the assets on Form 4797 and on Form 6252. And then in addition to that, you would attach Schedule D. So this is much of what happened in our illustration earlier today with Diana Prince. Diana Prince sold her property and reported the sale on Form 4797. But if she had sold the property under the installment method, then she would also need to complete 6252 and then continue filling out Form 4797 and Schedule D. Electing out of the installment method. If you elect not to use the installment method, you generally report the entire gain in the year of sale, even though you do not receive all the proceeds in that year. So what this is saying is that the installment method is actually automatic. And the only way you don't report a sale under the installment method is by electing out of the installment method. Well, how do you do that? Well, if you have a $100,000 gain on the sale and you only received $20,000 of payments this year, you would report all $100,000 of gain on your tax return even though you hadn't received all the payments. If you do that, then you are electing out of the installment method. But if, of course, you file Form 6252, then you are using the installment method. The other thing is, if you file late, you're going to be forced into the installment method because it has to be claimed on a timely filed tax return. How to elect out. To make this election, do not report your sale on Form 6252. Instead, report it on Schedule D or on Form 4797, whichever applies. When to elect out. You must make the election by the due date, including extensions for filing your tax return for the year of sale. So the elect out is an option that is available, but you must do so on a timely filed return. So if you file your tax return late, then it's no longer possible to elect out of the installment method, and you must file your return and report income from the sale under the installment method. So earlier I told you we would have a detailed illustration of an installment sale, and here it is. Sally Sale sold her vacation home on June 30th, 2010 for $350,000. She paid $5,000 in selling expenses. Sally originally purchased her home back on June 1, 2010 for $150,000, and she claimed $2,000 of depreciation on her home in prior years. Sally received $18,000 in payments for the year, of which $12,000 was applied to the principal amount of the loan and $6,000 was applied to interest. Sally has a W-2 for the year as well, and it is shown right here. It shows wage income of $50,000 and federal tax withheld of $8,000. We begin preparing Sally's Form 6252 to calculate her income from the installment sale. And this is a pretty detailed form. It's got lots of lines and different sections for computing them, definitions that you have to understand, so I'll break it down as succinctly as I can for you. Of course, we begin up at the top by entering the name of the person who sold the property, a description of the property being sold, the date acquired, the date sold, and then we answer the questions, was it sold to a related party? And the answer is no. We then go over to part 1 of the form and begin with line 5. On line 5, we enter the sales price of the property. That was $350,000. Line 6 asks you to enter any mortgages, debts, or liabilities that the buyer assumed. Well, the buyer in this case assumed no debts for the seller. Then on line 7, we subtract line 6 from line 5 and enter the difference, in this case $350,000. Then on line 8, we enter the cost of the house. The house was originally purchased for $150,000, and that is what we enter there. We then enter any depreciation that was claimed on the home after May 7, 1997, and that amount was $2,000. Of course, that reduces our basis and gives us an adjusted basis in the home of $148,000. Next, we enter any expenses of the sale, and that was $5,000. And of course, $5,000 plus $148,000 gives us the amount that is now entered on line 13 of $153,000. Then on line 14, we subtract the installment sale adjusted basis from the contract sales price. Well, the contract sales price is $350,000. The adjusted basis is $153,000. The difference between those two numbers is $197,000. On line 15, this was not a sale of a main home, so there is no exclusion of a gain that is allowed for Sally's sale. The entire gain is taxable. The entire gain that is taxable is $197,000, and we're going to divide that by the contract sales price of $350,000. And when we do that, we enter the total on line 19, which is 56.286%. Next, we look to the total amount of payments made on the property during the year. Sally received $12,000 of payments, so we enter those on line 21. We then multiply the amount of payments received during the year by the gross profit ratio, and the result of $6,754 is entered on line 24. No amount of gain is due to recapture of 1245 depreciation, so line 25 is blank, and we end up carrying the total to line 26. The amount shown on line 26 is going to then carry over to Schedule D and be entered on the line on Schedule D that calls for that entry. So I'll show you that in just a moment. And here is Schedule D, and you can see on Schedule D there is a space provided on line 11 to enter any long-term gain from Form 6252. So we enter the gain from 6252 on line 11, $6,754. Next, we also carry that total down to line 15. Line 15 carries over to page 2 of Schedule D, and on page 2, line 16 will carry over to Form 1040 and get entered on line 13 as capital gain income. Then on line 19, we enter the portion of gain that is attributable to prior depreciation, and that was $2,000. And the $2,000 of prior depreciation is taxed at a maximum rate of 25%. So moving over to the Form 1040 and finishing up Sally's sales tax return, we have line 7 wages of $50,000. Remember that she had some interest income on that sale as well. In the wording of the problem, I told you that she'd received $6,000 of interest income. That is entered on line 8. And because her interest income is more than $1,500, she is required to file Schedule B with the return, and that Schedule B is right here. So we enter the name of the buyer. In this case, we entered Bob Buyer, his Social Security number, his address, and the amount that Bob Buyer paid to Sally's sale during the year. $6,000 carries over to line 8 and is entered as income on Sally's tax return. Next, on line 15, we enter the capital gain resulting from the sale reported on Schedule D, and that was $6,754. We add up all of those income amounts, and we end up with line 37, adjusted gross income of $62,754. Then on line 38, we carry over her adjusted gross income. Line 40, we enter her standard deduction of $5,700. We also subtract out on line 42 her exemption deduction, and that leaves us with $53,404 of taxable income. We carry the amount on line 43 over to the Schedule D worksheet and enter that on line 1. We then use the Schedule D tax worksheet to figure the amount of tax that Sally owes for the year. $2,000 of unrecaptured Section 1250 gain is subject to a maximum capital gain rate of 25%. The remaining $4,754 of gain is going to be taxed at a rate of 15%. So the worksheet, of course, asks us to do a number of things. Let's take a look at that. Line 1 taxable income is $53,404, and from that we need to subtract out $6,754 that is capital gain income. When we do that, we're left with $48,650. That number is carried over and entered on line 19. We then take line 19, go to the tax tables, and look up the amount of tax that Sally owes on $46,650. When we do that, we get $7,850, which is entered on line 34. The next step is to see whether Sally will qualify for the reduced capital gain rate of 0%, but her income is more than the threshold amount for her filing status of $34,000. So we take 53, we subtract out 67, and we end up with 48. This $48,850 is more than the base amount for her filing status, so it means she's not eligible for the 0% tax rate, and all of her gain is going to be taxed at 15 or higher. So we enter the amount that is eligible for the maximum rate of 15% on line 21. We carry it to line 23 and then multiply that by 15%. When we do that, we get $713. The next step then is to enter $2,000 on line 20. That is the amount of gain that is going to be taxed at a maximum rate of 25%, and 25% of $2,000 is $500. We then take $713 of capital gain, add $500 of Section 1250 gain, and the $7,850 of ordinary income tax. We add those numbers together and we get $9,063. Now we look at the amount of tax owed on $53,404, and that was $9,538. So $9,538 is more than the amount we show on line 35, and so we get the lesser of those two numbers. $9,063 will carry over to 1040 and is entered here on line 44. Now we look at the amount of withholding that Sally had on her W-2. That was $8,000. We add in a making work pay credit of $400. That gives her $8,400 of taxes and credits. We subtract the tax from her withholdings, and she ends up with a balance due of $663. So that concludes the lecture portion of Session 16 involving installment sales and sale of the home. I'm going to give you another password right now. This password is the password to unlock the quiz answer key for Session 14. That password is transporter, transporter. Please jot that down and use it to unlock the Session 14 quiz answer key. And here is the classwork assignment. The classwork assignment for today's session involves preparing a tax return for Lois Lane. And Lois sold her home to Clark Kent for total compensation of $500,000. Lois first bought her home on 12/13 of 2001 for $130,000. Lois made the following improvements to her home while she owned it: landscaping of $5,000, a remodeled kitchen of $20,000. She added a bathroom for $10,000 and put a new roof on, costing $7,000. In 2008, she claimed business use of her home and a depreciation deduction of $1,000. She had the following expenses relating to the sale: real estate commissions of $30,000 and closing costs of $2,500. Clark is buying the home from Lois on an installment sale. He paid $50,000 down and assumed her $100,000 mortgage. He will pay her the remaining balance in payments over 30 years. The stated rate of interest is 7.5%, and the sale closed on 5/31 of 2010. Clark paid down $50,000 and began making monthly payments on July 1, 2010. Lois will receive a $400 making work pay credit. Use the attached amortization schedule and Lois's W-2 to prepare her tax return. Here is her W-2 showing wage income of $55,000. Federal income tax withheld was $12,000, and state income tax withheld is $6,000. Here is the amortization schedule for Lois Lane's sale. It shows the date sold, the principal amount of the loan, and the principal amount of each payment during the year. The total payment was $2,432, but the amount for principal is $245, and the difference between those two numbers is going to be interest. So at the beginning of the year, her principal amount on the loan is $350,000. We go to the final payment that was made during 2012, and that is the payment that occurred on 12/1 of 2010, and the balance at that time is $348,510. If you take $348,510 and subtract that from $350,000, you will have the amount of principal that was paid for the year. And if you add up the total payments that she received for the year and subtract the amount of principal that she received from the year, you will have the amount that is interest. So I'm asking you to do a little bit of thinking there to figure out actually how much interest she had. So at this point, please push pause on video playback and complete a tax return for Lois Lane. The forms you will need to prepare in completing Lois's tax return is 1040, a Schedule A, a Schedule B, Schedule D, Form 6252, the Section 1250 gain worksheet, and the Schedule D tax worksheet. Have fun with this assignment. I do expect it will take you a little bit to complete it, but it's a good exercise. You'll learn a lot doing it. When you are finished preparing Lois's tax return, Please resume video playback and I will go through a review of Lois Lane's tax return answer key. So I have up in front of you now the classwork answer key for Lois Lane's tax return. And it begins with a description of how to complete Form 6252. And in Part 1, on line 1, you enter sale of home, you enter the sales date, the purchase date. We enter the answer no because Lois did not sell to a related party. If her sale were being reported directly on Schedule D, we would need to add expenses of the sale to the acquisition cost and enter that as part of the cost basis. However, since we are reporting the sale as an installment sale, Form 6252 asks for the selling expenses to be listed separately as follows. We get the cost of the home by adding the purchase price, landscaping, kitchen remodel, and bathroom, and new roof together, giving us a total cost of home of $172,000. We then take the selling expenses, which were $30,000 plus closing costs of $2,500, to get total selling expenses of $32,500. And here is Lois's finished Form 6252. As I said, we enter a description of the property, date acquired, date sold, not sold to a related party. Then in Part 1, line 5, we enter the selling price of the home. On line 6, we enter mortgages, debts, and other liabilities assumed by the buyer, and that was $100,000. We subtract 6 from 5, and we're left with $400,000 on line 7. We then get the cost or other basis in the property sold, and enter that on line 8. That was $172,000. Line 9 asks us to enter any depreciation that was previously allowed or allowable, and that was $1,000. We subtract line 9 from line 8 and enter $171,000 on line 10. Then line 11 asks us to add back in expenses of the sale. Line 12 asks you to enter income recapture from 4797 Part 3, and the amount that you would enter on line 12 would be recaptured depreciation on the sale of Section 1245 property. But recovered depreciation on the sale of Section 1250 property is entered on line 9. So we make no entry on line 12 for Lois. Line 13, we take line 10, add that to line 11, and we get $203,500. The next step is to subtract line 13 from line 5, and when we do that, we get $296,500. Lois did sell her main home, so she was able to claim an exclusion in the amount of $250,000. That leaves her with a taxable gain of $46,500 and a contract sales price to Lois of $400,000. We take $46,500, divide that by $400,000, and we get a gross profit ratio on line 19 of 11.625%. We then take line 19 and multiply that by the total amount of payments that Lois received during the year. So let's go see how we figured out the amount that we end up entering on line 21. Returning to the student manual and looking at the amortization schedule for Lois Lane's sale to Clark Kent, we show principal payments made during the year: $245 plus $246 plus $248 plus $249 plus $251 plus $252. That equals $1,491. We add $1,491 to the down payment of $50,000, and we get $51,491. The next step is to take $51,491, multiply that by the gross profit ratio of 11.625%, and when we do that, we get $5,986. This amount will then carry to Schedule D and is entered on Schedule D. And here is Lois's Schedule D. And you can see here on line 11 it says enter the long-term gain from Form 6252. So we've entered $5,986 from the 6252 form. That is the only capital gain she has for the year. We carry that to line 15 and on to line 16. And then, of course, how much of line 16 is a recovery of depreciation? Well, $1,000 is. Now let's prepare the rest of Lois's tax return, beginning with her Form 1040. Of course, her filing status is single. She has a W-2 for $55,000. And wait, what's this? Interest. Well, how did we figure that number? So where did we get this $13,101 of interest income that we've reported on line 8A? Well, let's go back over to the amortization schedule for Lois Lane and look at the payments that she received during the year. We have 1, 2, 3, 4, 5, 6 payments of $2,432 that were received during the year. If we take $2,432 and multiply that by 6, we get $14,592 of payments that she received during the year. From that, we subtract the amount of total payment that is due to principal. And remember, we figured that amount earlier at $1,491. So we take $14,592 and subtract out $1,491, and we are left with $13,101. Because this is a seller-financed installment sale, we need to report the name, Social Security number, and address of the buyer who paid interest on line 1 of Schedule B. So we show that Clark Kent paid Lois Lane interest of $13,101 on Schedule B. So returning to Lois's 1040 return, we have $55,000 of wage, $13,101 of interest income, and $5,986 of taxable income from her installment sale. That gives her income for the year of $74,087. She has no adjustments, so her adjusted gross income on line 38 is $74,087. Her only itemized deduction reported on Schedule A is state withholding of $6,000, so we've entered $6,000 on line 40. We also subtract out her personal exemption deduction of $3,650, and that leaves her with taxable income of $64,437. What's next? You guessed it, the Schedule D capital gain worksheet. And here is the Schedule D capital gain worksheet. The first number that we enter on line 1 is the taxable income from line 43 of her Form 1040. That's $64,437. Next, we enter on line 7 the amount of capital gain showing on line 16 of her Schedule D. And then on line 11 and 12, we show the amount of gain that is attributable to recovery of depreciation. Subtract the depreciation from the gain, and we're left with $4,986 on line 13. We subtract $4,986 from the amount on line 1, and we're left with $59,451. The next step is to see if the amount on line 14 exceeds the threshold amount for Lois's filing status, and it does. Her income is more than $34,000. That means she will not be eligible for the 0% tax rate, and she is in fact in the 25% or higher bracket. So she will ultimately have $4,986 that is taxed at a rate of 15%, and she will have $1,000 that is taxed at a rate of 25%. All remaining income that she has for the year will get taxed at her ordinary income tax rates. So the next step is to subtract $5,986 from $64,437, and we get $58,451. This amount of income is the amount that we will use to figure the tax from the tax tables for Lois Lane. So we go to Pub 17, flip to the back, look up the tax shown in the tax tables for $58,451 of taxable income. We then enter that tax on line 34, $10,800. The next step is to figure 15% rate of tax on $4,986. That is $748. We then figure 25% on $1,000. That's $250. And we then take $748 plus $250 plus $10,800. We total those up, and we get $11,798. The next step is to go to the tax tables and look up the total tax owed on all of Lois's taxable income for the year. So the tax tables show that the amount of tax owed on $64,437 is $12,288. Lois is allowed to claim the lesser of the amount on line 35 or the amount on line 36, and of course line 35 is the lower number, so we're going to take $11,798 and enter that on line 46 of Form 1040. We now look to the withholding that Lois had on her W-2. We add in the Making Work Pay credit and show that her total withholdings and credits are $12,400. That is more than the tax she has showing on line 60, so Lois is due a refund of $602. So that concludes the review of the answer key for Lois's tax return. And the final password that I will be giving you today is the password that you will use to unlock the Session 16 classwork answer key. That password is Warmblood, WARMBLOOD. And here is the homework assignment for you to complete. It involves preparation of all of the same tax forms that we just saw for Lois Lane, plus, what's this? Form 4797. So this is basically taking a tax return like Diana Prince and adding 6252 to it. So Lana Lang lives on Smallville Way in Kansas, and she sold her rental home during the year to Lex Luthor. The sales price is $180,000, and Lex made a $40,000 down payment at the time of purchase. Lana originally purchased that rental house back on January 15, 2010 for $102,000. At the time, the land was worth $22,000. She did not ever live in the house, and she had the following closing costs that she paid on purchase, which were added to her basis in the property. We have title charges, other closing costs, and a tax lien that she paid for the seller at that time. Now, over the years, Lana made the following improvements to the property, including a new deck and roof. Lana did not rent the property during the year. She left it vacant so that it would be easier to sell. Lana's depreciation schedule is shown below. Depreciation is the only expense that she had on the rental during the year. These items here show her current depreciation, which is the only expense you will enter on her Schedule E for the year. Lex is purchasing the home from Lana under a seller-financed mortgage. The amortization schedule is attached, and Lex made his first payment on June 1, 2010. Lana incurred the following expenses in relation to the sale of the property, including real estate commissions and closing costs. For purposes of calculating gain or loss on the sale of this rental property, please treat the entire sale as a single transaction reportable in Part 3 of Form 4797. This is because that whatever gain you figure in Part 3 of Form 4797 is going to carry over to 6252. So you're actually going to complete Form 4797, but you're not going to put a whole lot of entries on it. So it's going to be a little bit of work. You need to do the 4797 Part 3. You also need to do the 6252. Numbers from 6252 carry over to 4797. Then 4797 carries over to Schedule D and to the front page of the Form 1040. So this will be an interesting exercise for you. Lana's W-2 and amortization schedule are attached. We can see she has a W-2 from the Talon. Here is the amortization schedule. Please go ahead and prepare Lana Lang's tax return. And at the beginning of Session 17, we, of course, will start class with a review of the Session 15 quiz answer key. We will then move on to a review of the tax return answer key for Lana Lang before we move on to the Session 17 lecture topic, which will be rental income and expenses. Thank you, and I'll see you again back at the beginning of Session 17.